Great, thanks. So this paper is joint with Philippe Aghion and Ben Jones, and Ben and I are going to do a tag team for the presentation. We want to explore the implications of artificial intelligence for economic growth. We're going to build some growth models. We're going to use those to tell some stories. So stories about what might happen to long-run growth and what might happen to the share of GDP paid to labor versus paid to capital, and what might happen with respect to a singularity. And I guess in working on this project, we've realized that the space of possibilities is extremely rich. And so we're going to pick out some stories to tell, but you could tell different stories. And there's a growing literature on this question. And if you look at Daron's paper with Restrepo, for example, they're just very different stories one can tell. So I just wanted to highlight that. We're going to pick a few. There are two main themes that we focus on throughout the paper. One is that we think of AI as the continuation of an automation process that's been going on for more than 100 years. So that's how we're gonna think about AI and embed it in the model. Automation we're gonna think of as replacing labor in particular tasks by machines and algorithms. And so in the past, this could have taken the form of textile looms, steam engines, electric power, more recently computers, and in the future, driverless cars, paralegals, pathologists, maybe researchers, maybe everyone. These are the kind of things we're thinking about. The point is that automation's been going on for a long time, and AI is the latest version of that automation. It may be applying to a different set of tasks performed more by skilled people than by unskilled people. But the sense is that it's useful to have this perspective because it allows us to use historical experience to maybe tell us about what might happen in the future, or historical experience to discipline the stories that we're going to tell about what might happen in the future. The second theme is that we think the growth benefits of AI might be constrained or limited by Baumol's cost disease. And this was a hypothesis that Austin actually mentioned yesterday in one of his comments, and we're going to build that in. It's going to play a very important role in what we do. So by Baumol's cost disease, we see his insight as saying that economic growth is constrained not by what we do well, but by what's essential and yet hard to improve. And you'll see that theme kind of developing throughout the models that we build. OK, so the first model I want to focus on is an old model, one of the first models of automation that I know of by Joseph Sierra in 1998. In a simple version of his model, production involves n tasks. And these tasks enter production in a Cobb-Douglas fashion with constant returns to scale. Okay? Each task can be either automated or not automated. And when they're not automated, 1 unit of labor can produce 1 unit of the task. When it's automated, you have an alternative, that now you can also use 1 unit of capital to produce 1 unit of task. And we'll make assumptions so that if it's possible to automate, you're just going to use capital. And that follows quite naturally here. So if you substitute this sort of automation, not automation, capital and labor into the task production function, you get our old friend, the Cobb-Douglas production function, with k to the alpha, L to the 1 minus alpha. And I'll just repeat that here at the top of the slide. So this is nice and familiar to all of us, certainly to growth economists. And one of the things that's nice about the Sierra sort of foundations for this is it gives us an economic interpretation of alpha. Alpha is now the fraction of tasks that can be automated. And we can think about automation as just changing the alpha. OK, if we hold constant alpha for a minute, we can embed this in a neoclassical growth model. And that's just the first model that we all learned in macroeconomics with Cobb-Douglas production. So everything's really straightforward. And we know from that setup that in the long run, the growth rate of income per person is proportional to the rate of technological change, GA. And the factor of proportionality is this 1 over 1 minus alpha. What's that doing? Well, if you have an improvement in technology, that raises output directly, right? That's the A raising the Y. But that leads to some capital accumulation. And because of automation, that capital accumulation is valuable, right? So if you increase K, you increase Y by alpha %. And then that feeds back into increasing K and increasing Y. And that sort of the sum of that geometric series is 1 over 1 minus alpha. So that's what the 1 over 1 minus alpha is doing there. And so this has sort of a nice prediction, a really strong prediction, that if we imagine a world where there's an increase in automation, that increases alpha. Well, from Sierra's model, that increases the capital share. And in the long run, that should raise the long-run growth rate. So that's great. A simple model, clean, really strong predictions. The unfortunate thing, and one of the reasons why Zier's paper didn't catch on as well as it should have, is that when we look at the data for the 20th century, it doesn't look like that at all. Right? For the bulk of the 20th century, there's a ton of automation. Right? That was kind of the theme that we started with, and that's been developed in various ways. There's lots of automation, but we know from Kaldor's facts that the capital share and growth rates were very stable over the 20th century. You don't see big increases in capital shares and big increases in growth rates. So there's something wrong in this setup. There's something incomplete, and we need to figure out a way to improve the setup so that we can still capture automation, but maybe be reconciled with the Kaldor stylized facts for the historical episode. Okay, so subsequent research by Acemoglu and Restrepo and many others have developed this theme, built on it in different ways. In the interest of time, I'm going to skip the literature view. What we add to sort of reconcile Zier's approach with the evidence from the 20th century is Balmo's cost disease. That's going to be our device for fixing this problem. We think, Balmo's cost disease applied here says that, well, agriculture and manufacturing are sectors with rapid growth and declining shares of GDP. These are also the sectors with rising automation. And so here's sort of the intuition for the reconciliation. The aggregate capital share could reflect a balance of these concerns. So within agriculture, within manufacturing, where the automation's proceeding, well, the capital share should be rising. That's a force that tends to raise the aggregate capital share. But because of Balmo's cost disease, those sectors are declining as a share of income, that's going to tend to depress the aggregate capital share, and maybe those two things can balance. Maybe this is a general feature of the economy. First, agriculture's automated, then manufacturing, and then maybe because of AI, maybe services gets automated. So that's how these things are going to fit together. So to build this into a model, we're going to change Zier's production function from Cobb-Douglas to CES. So it's CES over tasks. You can think of the tasks as being ordered from sort of easiest to automate to hardest to automate. The elasticity of substitution in this production function, we're going to make less than 1. These are complements, and that's going to capture the Balmo insight here. So that parameter rho is going to be negative. Essentially, one can view this production function as saying that it's like a weak link production function. GDP is going to be limited by the tasks that you're worst at. Right? And those are going to be the labor tasks, and so those are going to be the constraints here. So let beta denote the fraction of tasks that are automated as of some point in time. And then if you substitute in, we've got k units of capital. We put them on beta tasks. So k over beta is the amount of capital we use for each task. We've got 1 minus beta tasks that are not automated. So L over 1 minus beta is the amount of labor we use on each task. If you collect the betas and collect the 1 minus betas, you get a normal CES production function where the inputs are B times K and C times L. And again, that's a very conventional neoclassical kind of production function we're used to working with. The B is beta raised to a negative power. The C is 1 minus beta raised to a negative power. So automation causes B to decline and C to increase. And what's interesting about this is it says that automation is labor augmenting, but capital depleting. And if you look back, the k over 1 minus beta, you're spreading your capital over fewer and fewer tasks, and that's where that's coming from. We know from, again, working with the CESs, you can write down the ratio of the capital share to the labor share as beta over 1 minus beta, this equation here. An increase in beta, since rho is negative, is going to increase the capital share. That's automation raising the capital share. But capital accumulation, since rho is negative, is going to lower the capital share. And this is sort of how things might balance. So to make this work, we need to specify a law of motion for automation. And it turns out something that's quite natural works really well here. And that is to suppose we've got a bunch of tasks that have been automated, a bunch of tasks that have yet to be automated. Suppose a constant fraction of the not yet automated tasks get automated at each point in time. Okay, so that fraction is going to be theta. Well then, beta is going to 1. Eventually all the tasks are going to be automated. C, though, is going to grow at a constant exponential rate. Right? The fraction of tasks that are not automated is falling to 0 at a constant exponential rate, so C rises. You're concentrating your labor in a smaller and smaller number of tasks. So this is a standard neoclassical production function. B goes to 1. It's got labor augmenting technological change. According to Yuzawa, this gives us balanced growth in the long run. right? All tasks eventually become automated. Beta goes to 1. Agriculture and manufacturing shrink as a share of the economy. The fascinating thing here is that labor still gets 2/3 of GDP. That's the surprise. You might have thought, once everything's automated, what's there going to be left for us to do? Well, we're all concentrated on a smaller and smaller number of tasks, but according to Baumol, everything else is cheap, right? We're concentrated on a small number of tasks, but those are the tasks that are the weak links. So those are the things that are valuable. And if you simulate this setup, you can get stable growth. Fraction automated goes to 100%, but the capital share levels off at 1/3. The labor share levels off at 2/3. And so that's the kind of thing that's possible here. So let me turn things over to Ben now.
Okay, is my mic on? Or? Yeah, okay. Thanks, Chad. And great to be here. Thanks to the organizers again for just, I think, probably the most stimulating conference I've ever been to, I would say. It's been really, really fascinating. I'm learning a lot, changing my views. So I'm going to continue these thoughts about growth in a couple of different directions. Let me do a brief detour on the subject of income inequality. That's a topic that's coming up a lot in the sessions today. And as Chad said, there's sort of many models in our paper. It's kind of a potpourri of various ideas, so this is sort of disconnected from other thoughts. But one thing that's kind of interesting to think about, and we talked about horses yesterday, and sort of the standard, I think, first intuition logic is that you kind of, AI works from the bottom up in the skill distribution, you replace low-skilled labor, it increases the skill premium. Crusell et al. Have a paper that's, puts that in a macro context. But it could get more complicated, right? The future's also surprising. So a slightly richer view, or at least more nuanced view, might be that, as we move towards harder problems, less routinized work, and taking sort of Jeff's organizing dichotomy this morning, if the problems get kind of messier, it can be the case that you have production functions which increase complementarity between high skill and low skill workers. So think about a law firm, kind of amorphous tasks where it's really important to have great legal assistants, great paralegals, et cetera. And as we move into kind of collectively, collaboratively working on these types of problems, you could actually have low skilled labor become the weak link, if you will, within an organization and actually start getting the rents. So Philippe has been thinking about this in another paper, and just to give you one fact along these lines, this is using UK employee-employer match data. Here's high R&D intensity firms, and these are the wages earned by high, middle, and low-skilled workers. And you actually see that the sort of, as you go to these, if you want to think about these kind of harder problems of R&D, you actually see the wage gains are pretty much going to the low-skilled workers, which is kind of interesting and is consistent with that kind of complementary view. Of course, a lot of workers might be down here, so this might be still inequality exacerbating, but it's in a more nuanced and subtle way. That's interesting to think about. Okay, so that's one of our topics. All right, so you can look at the paper for more on that. I'm going to continue, and now in a more unified way, with the theoretical ideas that Chad was presenting. If you think of what Chad was starting with, it was automation of tasks in the production function of goods and services. But another theme is the possibility of automation of tasks in the production of ideas. Okay, and so what does that do if we think about the ideas production function? And so we'll take a very simple framework. We'll actually reduce production of goods and services to a very simple labor-only model. Well, that's not important. And we're going to do something very similar to what you saw before. This is now the idea of production function. So instead of output on the left-hand side, we have the rate of change of ideas, or productivity. And you have now kind of a to the phi on the right-hand side, because we want to think about various ways in which the advance of the stock of knowledge may have positive or negative effects on our capacity to further innovate. Again, Baumol, in the sense that there's an elasticity of substitution that's less than 1, or rho less than 0 in that parameterization. Again, beta is the share of tasks that are automated, but now in idea production, in this production function. You end up in a very similar place. It's just like what we saw before, only we're talking about ideas production. This B, weighting capital, and C, weighting, this is now the share of, this is labor, but scientists, if you will, for S, labor put into idea production. This is just like before, okay? So just to see that again. Okay, so the intuition is the same. So as growth progresses, the scarce factor is what becomes important, okay? So if capital is in here, we have another constant returns to scale production function within idea production. Basically, and imagine there was no increasing automation, so B and C is fixed. Basically, we imagine the capital-labor ratio going up over time, so kind of the capital input becomes less important. Scientists become the scarce piece, right? And it's pretty reasonable to think that we have an elasticity of substitution less than 1 in idea production. For example, we might think that if there were no people involved, we probably wouldn't get anything out. So they seem essential, and sort of essentiality of humans is sort of related to a rho less than 0. So in any case, you can add automation. You're still under very weak conditions, going to have this where the scientists become the scarce factor. So this production function asymptotically becomes this as we automate. So if you have continuous automation, this is the production function. We've now simplified this into where you end up, which is scientists being the scarce factor. Now that might look very familiar to you if you're used to endogenous growth models, because this is how we typically write it, where we say, the advance in ideas depends on something about the stock of ideas, ignore C for a second, and your labor input, okay? In standard endogenous growth, the original models, phi was equal to 1, right? Which means I could divide through by A, so you have a constant growth rate if you have a constant labor input, okay? And so one of Chad's big insights in the 90s was that, well, wait a second, we have more and more effort going into R&D. So if this is growing, we would then have explosive growth. So that suggests that phi is actually less than 1. Okay? And then if you do that, if phi is less than 1, then you have steady growth. We're putting more and more effort into R&D, and there's a variety of micromechanisms that could possibly explain that. The difference here only is C. Okay, so again, this is the automation, or the continual rate of automation in this Baumol's context kind of makes labor more productive, if you will. And so the only difference here is that with phi less than 1, so things don't explode, if it were just that, that's your standard endogenous growth theory. Now we're just adding this automation effect. So in other words, automation gives you a boost on the growth rate, but it doesn't change the fundamental idea of sort of a constant steady state growth rate. Okay? All right. So now we're going to get a little further out. Okay? We also get into singularities. This is a nice opportunity to think about singularities. What happens if we really go all the way and allow AI to take over all tasks? And we've had some narratives along these lines in the last couple of days. You can decide for yourself how much you believe this is a possibility. I've been updating in that direction, actually, given Vinod Khosla's presentation at lunch. I think the AI presentations at dinner last night suggested that the conversation wasn't these things are impossible, but they're maybe decades away on certain other tasks. You can, I think Danny Kahneman's presentation this morning also suggested that these AIs might do a lot. But in any case, what would happen if it takes over all tasks? So we have 4 examples of this in the paper, but let me just give you 2. First, imagine complete automation in goods production, back in the ordinary production function. That just pushes you into AK. Basically, K does everything, right? There's no labor anymore, and you have A. So as we know in these models, well, if K is growing and A is growing, the growth rate's going to increase, right? In fact, the growth rate, which is normally would be that based on A, is also benefiting from the growth of capital, which of course tracks back into A because we make K out of Y, which follows A, basically. So this is unstable, it's growing. So basically what we would see is what we call in the paper a type 1 growth explosion. No singularity in a mathematical sense, but growth would in fact increase and increase and increase in its rate, which seems consistent with what some people like Kurzweil seem to be describing. Or maybe John von Neumann, actually, back in the 50s or 60s. A more extreme singularity occurs when you put it in the ideas production function. So if you fully automate ideas production, what happens? So now, this used to be labor, right? Ideas production. Now it's capital, okay? The difference is that labor grows at some rate of population growth in steady state. But this isn't constrained. If we can grow Y faster, we can grow K faster. And that's going to tend to want to make things blow up, okay? And in particular, intuitively, that's going to grow kind of like A, because think about a balanced growth path. K over Y is constant. Y scales with A. So K kind of wants to scale with A. Okay? So that's sort of like this. And we do a more complicated version in the paper. But intuitively, it's like this. It's sort of like we've added 1 to phi. Okay? And so basically, things are going to now explode at a lower phi. With labor only, if phi was greater than 1, things explode. With automation, phi just has to be greater than 0. As long as there's any net positive intertemporal spillover, things would explode. Okay? All right. Then you actually get a true mathematical singularity if you solve the differential equation. If phi is actually greater than 0, you really do reach infinite productivity, or some approximation of that, in finite time. All right. So let me just do this, and then we'll stop. Why not So we also discussed why none of this might be possible. So obviously, if we think there's automation limits, AI really can't do everything, you end up with a scarce factor where in Baumol world, that limits us, okay? So that's one way to avoid these kinds of singularities. Another would be in search. It may be the case that phi really is less than 0. So there are stories like fishing out or my burden of knowledge story, which suggest phi is less than 0. Those would be micro-mechanisms for that, in which case automation would accelerate growth, but it wouldn't actually lead to an explosion. And then lastly, I think natural laws are a possible restraint. Instead of having one A, have an A, many different kinds of output, all right? In this model, in our Baumol model, you can take A to infinity and all sorts of stuff, and it becomes irrelevant. It gives you growth for a while, but then it doesn't matter anymore. It disappears. And all that matters are the things you're bad at, okay? And then all that you're left to grow on are improving the things that you're bad at, the constraints, okay? Moore's law might be instructive. We're like 100 billion times faster in computation than we were 40 years ago. Are we 100, but we're not that much richer. In fact, if anything, that keeps going on, it doesn't seem like we're getting much growth out of it. It might be so good it's become irrelevant, right? Because computation, we're really great at that, but the hard problems, we're not improving, and that's actually where growth is going to come from. Think about Carnot's theorem, which is a very strong limiting feature in thermodynamics about how efficient energy production can be. Okay, so that's the theme. Baumol, I think, is a very strong theme. If you believe in Baumol, in some sense, we can get super excited about AI and super excited about lots of technologies, but in some sense, they're exciting, but those are the ones that actually, in the end, don't matter as much. It's the ones that we find hard. I think that's an important theme, I think, for us that came out of this work together. These are just repeating what I said, so thanks very much.
Thank you. Okay, so thanks to the organizers for inviting me, and it's been a real pleasure to read this paper and to listen to the talks. This is really groundbreaking stuff. So I think the aim here in this paper is an agenda for the field, and it really reads like that. It's a beautifully written paper, easy to understand, and extremely simple, full of ideas. So it's exactly what you want, if that's your aim. It really can be broken up into two sorts of parts. I mean, this is kind of schematic, but I think this is kind of consistent with the way they've discussed it. One is they're going to explore the growth implications of AI. When we think of AI as just increasing automation in production. And that's simply capital replacing labor and an increasing range of production tasks. The second part of the paper is going to look at AI as augmenting idea creation. So here it's capital, again, replacing labor, but in the augmenting of the production function. Okay? So both of these ideas are going to be explored and structured by essentially thinking of the zero model and extending it in a very simple way and a very intuitive way. Okay, so that's theory. How is it going to be disciplined here? Well, there's kind of two forms to the discipline. One is basically looking at the Kaldor facts and saying, if you do this, can you match the Kaldor facts? Why would we ever want to? Well, the idea, and I think it's very compelling, is that automation's been going on since the Industrial Revolution, probably before. Any model we write down projecting what might happen into the future with continued and maybe accelerating automation shouldn't really fly in the face of the basic facts that have been governing change over the last 200 years. What are they? Kaldor facts, growth rates, factor shares, both relatively stable. Can we write down a model? Can we discipline our model with this and still get sensible stuff? Okay. So I think the paper does less here. I'm going to talk about this a little bit. If you can shoehorn the model into fitting the facts, you can. Is this reasonable? Does it lead to reasonable stuff? And we'll get to what I think can be done more on that later. A second form of disciplining is actually to throw out the disciplining. It's to say, look, we don't really need to look at history to look at actually what's going to happen, projecting into the future. Why? Because AI is really a game changer. Okay? And if that's the case, then we're not really tethered or needing to be stuck to the Kaldor facts. What's going to happen then? What could possibly happen? And here we get into kind of a different sort of set of conjectures where, I mean, I was kind of interesting to see this word singularity community. This is referring to a group of researchers, which I kind of think is maybe not disparaging, but suggesting that this is really out there stuff. Okay? So what the paper is going to do is actually provide a structured way of thinking about that out there stuff and show it's actually not very far away, if you're thinking about it in the right way, from our standard ways of thinking. They structure it in a particular way. How much time do I have? It's 10, right? Okay. Okay, so we saw this. Actually, my slides almost completely correspond to yours, so I don't think I need to go very fast over the recap. Key thing is with the zero model, which is extremely nice and simple way of thinking about this. When a task becomes automated, you can simply do it with capital instead of labor. Labor gets displaced from that task. One of the implications is that you're going to get an increase in growth rate as automation increases. Not the rate of automation, just automation. And actually a level increase in automation is going to increase the growth rate. Clearly flies in the face of the Kaldor fact, as we've seen. Okay, so one resolution is the Assembler-Restrepo resolution, which they didn't talk about, but let's just tell you about what it is in a second. You can have a constant alpha, and therefore a constant growth rate, if you simply allow the set of tasks to also expand. Okay, if you allow the set of tasks to expand, then you can keep the alpha constant, because although you're automating some, there's expansion in the margin as well, the extensive margin. Okay. Their resolution is different. Again, this is their slide, so almost exactly. So they're going to use a CES production function and allow for a less than perfect substitute. So less than a row, which is negative here, a sigma less than 1. Okay. Forget that. The interesting and surprising thing that this leads to a form of a neoclassical production function with labor and capital augmenting components. But the very cool thing is that increasing automation is capital diluting and labor augmenting, which is surprising. Okay? So what's the intuition? They gave it last time. Key factor is this rho negative or sigma less than 1, low substitutability across sectors. Automation, here's one way of thinking about it, is kind of generating an income effect. And we end up spending progressively more of our wealth on the sectors that are not automated. Okay? So this is leading to two counteracting forces. The direct one is automation is displacing labor. The indirect one is the relative price of the things that labor is doing are going up. Okay. So this can lead to balanced growth, and this is the condition that's required. Okay, so let me just quickly jump to some comments. Firstly, comment 1. So given a number of papers, both the scope and the quantity that Daron and Semiglu writes, I think you could say this about almost every paper. You have to position it better relative to Daron's, but I think you do in this case. And here's why. Of course, they talk about Daron's, but there's some sort of superficial similarities. Of course, they're both building off the zero model, but the precise connection isn't exactly obvious to me. I think it should be made very transparent. In particular, they, in their footnote 11, rule out what they call an implausible case, which is so strong substitution can lead to a type of an example where automation increases the productivity of capital may end up raising demand for labour more. I think they're ruling out the case that you're explaining. Now, I don't have a stance on whether that's all right or not. I think you should actually, if it is exactly that case that's ruled out, then you should establish that equivalence and actually argue for why that's actually not a reasonable position. Okay. I think that the model sells itself short in the sense that the authors do not endogenize the allocation of research effort to automation, just in the first part of the paper. Now, why? Here's their answer. Anything could happen, essentially. They've identified two forces that counteract and say, look, we don't really know, so why structure that? So I think it sells it short. Why it's easy to do this, relatively easy. I think it can be done simply, and it's going to give insights. It has potential to tell us about fundamental forces that could push towards balance. Semiglu and Restrepo actually aren't as shy about it. They do that, and they actually argue that there's, in the directed technical change literature, there's actually fundamental forces that will push us towards balance. So I'm worried that in your framework, the fundamental forces would actually push us away from balance. So in particular, you get more and more concentrated activity in a smaller number of sectors. If I'm just thinking about the kind of third generation endogenous growth models that try to get rid of the scale effects by expanding the number of sectors, that's how they diluted it. Here, I think you'll get increasing growth with those, if you look at the fundamentals of that. That's just my intuition, but I think in order to dispel that, I think it's a natural intuition for people who read those old growth models. I think you should explore that a little bit more. Finally, there's a bit on AI and business stealing. And here, I was actually optimistic about what AI would allow, in that one of the downsides of IT, information technology, is the plus is it allows information diffusion more quickly. The downside is it allows people to steal it more easily. But I think AI, and the authors want to make it, and this is a very small part of the paper, they want to make an analogy between these two things, and I think it doesn't fit that well. I want to understand that analogy better, so I think you should elaborate. In particular, I think AI, because it embeds technology in machines, which are much easier to control than labor that works with processes, it's actually more likely to be not subject to this negative effect of IT, which is the business stealing effect. So that wasn't elaborated at all in the paper, and it actually flies completely in the opposite of my intuitions about what would happen there. So I think that's really worth saying exactly what's going on there. Apart from that, there's a hell of a lot more in this paper. So I didn't even talk about the stuff that Ben talked about, the issue of singularities, superintelligence, and the bottlenecks, which I think are really interesting ways of thinking about why we won't necessarily get those. You should read it. It's simple and great. Thank you.
I wanted to speak just briefly about this issue of the labor share, which has come up in the last couple of talks. And it's always been the case that the labor share has not only differed dramatically across sectors, but fluctuated over time. Keynes, remarking on this, said, "This is one of the most surprising, yes, best established facts in the whole range of economic statistics, both for Great Britain and the United States." And a little later, the result remains a bit of a miracle. So we shouldn't look at the decline of labor share in manufacturing and say, oh, that's, this is at odds with our fundamental understanding. That would be predicted by any model where you have a kind of balanced growth path. But I do think there has been a recent decline in labor share, and the question is, what is it related to? One possibility, of course, is this is the the first horseman of the robocalypse. This is the machines taking all the jobs. But there are a number of papers now, including one that I've written with David Dorn, Larry Katz, Christina Patterson, and John Van Reenen, that relates this more to market structure and shows that where we see the decline in labor share is sectors that are becoming more concentrated. Jim Besson has a paper linking this specifically to information technology. And the key piece of evidence for that is that it's not the case that the median firm in any sector, the labor share is declining. It's that more economic activity is moving to the larger firms that have always had a larger labor share. So this speaks to market structure and this question of business stealing or competition, and also this conversations that Carl and I have had. And I do think, if you take that hypothesis seriously, it's not so much a matter of thinking specifically about what machines are replacing, but how digitization is changing the nature of competition, whether it leads to more winner-take-most markets, and what are the sort of antitrust or regulatory issues around that. So my question is sort of how do we think about that market structure component, which is sort of missing in the aggregate models. And a related question that I just want to throw out there is, it's often said that Google has a huge competitive advantage because it has access to all these data, and that'll just grow over time. And I wonder how replicable that stuff is once you have the processing. And maybe someone will speak to that later today. I hope they will, about how much that really is a kind of immutable advantage versus a transient phenomenon.
Well, I can be really quick because my question is almost the same as David's, and that is that in the model. You could have the price of capital going very, very low, especially if it's software and could be freely replicated. You go to zero, and so that could have the offsetting effect of more and more capital. But it's going to depend, I think, in part on the market structure. And there's a number of reasons, as David mentioned, that you might have a different market structure. I suspect Carl and Hal will talk about that as well. And it may not be as applicable. I saw you had a 500-year time scale in your last chart. That was good to see. But at least in the more immediate time frame, those factors may be particularly relevant. It'd be interesting to have you think about that or say something about that.
As a theorist, I find Baumol's cost disease argument incredibly convincing, and I was wondering what the historical evidence for it is.
We're shying away in many of these discussions from the politics of this. What market share, the reason that we worry perhaps about market structures, David is mentioning, is because this will have political ramifications. And we're not discussing that there are choices to be made about how we're going to manage labor markets. These are not things that are technologically driven, they're also social choices. So I'm raising this at this point because I think in the context of a particular model, there is something that could be done, because we know if we put in some sort of labor market friction here, as has already been done by Philippe in his work on distance to the frontier, or as has been done by Patrick as well in his work on contracting and growth, we can then start to talk about what are the best policy responses to the imperfections that we put into these models, in particular the labor market ones. Are they going to be of the form of contracting, or is it going to be redistributive, better legal systems? I'm not sure what it's going to look like, but at least it's worth examining in the context of this class of model. What are the policy responses that we want to think about?
Jan?
Yeah, I have a question that relates to, I guess, a point that was alluded to here, which is whether the nature of AI technology and the information that it uses will make it easier or more difficult for the technology to diffuse across the industry. Is it going to be more widely shared or less? Now, there is an important point which I think distinguishes the AI sector from a lot of others, which is that within the companies that have a lot of activities in AI, either in products or research or both, there's two categories. There's a category where Facebook and Google are the best examples, where the research part of the AI activity is completely open. Those two companies are completely non-obsessive compulsive about IP. They have widely advertised policy that they're not going to sue people for infringing on their IP. There are patents that are filed solely for defensive purpose. And the idea is somehow that if we share the information with the wider research community, the field as a whole will progress faster, and that's really what we're after, because we don't have the technology we need, and we need everybody's help. We don't have a monopoly on good ideas. So that's one part. And then there is another set of companies like Apple and Amazon, which are the best examples. And they are completely secretive. They don't talk about anything. They don't publish anything, or very, very few things. And the difference is that those companies are focused on consumer products, consumer devices. And that leads them to have a completely different attitude. Another example of this is Samsung. These are very obsessive compulsive about IP. They file systematically patents. Whenever they have agreements with universities, they want to own everything, which is not the case with the others, which basically say, you can do whatever you want with the technology that we pay you to develop, as long as you can't stop us from doing whatever we want. So it's a completely different attitude, and I think it redefines a bit the attitude towards IP. It's interesting.
Thank you. Anton, and then Jeff Sachs, and then we'll give the authors some time.
First, let me say this is really an excellent paper, and I will for sure teach it in my first year graduate macro course. And second thing, if there's one concern I have, is that limiting yourself to the Kaldor facts may actually bias you a little bit, because most of what we have been concerned about in the past 3 decades, for example, has been deviations from the Kaldor facts. So that may be something that you may want to explore a bit more.
Jeff?
I just wanted to say a word of skepticism about the Baumol effect as being so self-evident. It refers to the general observation that services have increased while the goods-producing sector has decreased as a share of the economy. But we measure services so poorly that to claim that we know that the service sector productivity has lagged is a mistake. And this is certainly true in very fast-growing sectors like health, where there are profound improvements of productivity, basically unmeasured in the national accounts data, but that have transformed a lot of healthcare, for example. My own view is that the big increases of several of the service sectors, education, healthcare, certainly professional services, which is where the technical work of scientific consultancies, a lot of R&D, architects, lawyers, and so forth. I don't think that this is, we don't measure at all the productivity. And I doubt that, I see this as really a demand side effect. Education has increased because the returns to education have increased tremendously because of the very scientific revolution that we're in and that we're talking about. The size of the health sector has increased because it can do a lot more than it could in the past. So that's a demand side effect augmented by public outlays as well as private outlays. And so I just would not want to overemphasize this stylized observation, which to my mind is without data because we can't measure productivity, or we don't in the national accounts measure productivity in the service sector.
Okay, Chad and Ben, you want to wrap up?
Yeah, maybe I'll start just on this this last point. And Anton also asked about the Kaldor evidence. So I completely agree with 3/4 of what you said. So my favorite example of this is when you look at total factor productivity growth in the healthcare sector. According to the data, it's -2% per year for the last 50 years. And that's totally nuts. We know there's a ton of technological change. The people who've looked narrowly at categories document the technological change, so the enormous measurement, totally a problem. Why? So that part of Kaldor, I'm equally skeptical about. The part of Kaldor that we're relying on, the part of Baumol that we're relying on is only nominal spending shares. Okay, so price measurement, productivity is totally out the door. Just what share of GDP is spent on agriculture? Clearly that's declined. What share of GDP is spent on manufacturing? That's clearly declined. What share of GDP spent on health? That's clearly risen. Education has clearly risen. None of that relies on any price or productivity measurement at all. So we might be maybe appealing to Baumol. I sort of liked it for some reasons because it gets at the general gist, but what we're doing is a little different from Baumol as well. So I think that's the first clarifying point that I would add. Let's see. Anton also asked about limiting to Kaldor may bias what we're doing. We had even more in the paper than we had time to present. So we spent some time after getting the asymptotic balanced growth path that occurs 500 years from now. We spent some time saying, well, what could we do in this model to get it to generate something that had maybe high capital shares today and low growth? And we played around with some things. And if you sort of have periods of automation followed by periods where you're not automating, you can get that. So during automation periods, you'll see the capital share rise. During non-automation periods, you'll see the capital share fall. And with the right transition dynamics, you can get the growth. So I'm sensitive to what you're saying. There's some stuff on the paper. It's not at all dispositive or the right thing. Finally, thanks to Patrick for his great comments. One thing I would just say in terms of Acemoglu Restrepo, what I discovered, and I think Ben and Philippe too, working on this, Acemoglu and Restrepo, we all wish we could be Daron, because Daron can write 87,000 papers and do every model possible in one paper, a week. What I found is actually that one of the key simplifications we made was not endogenizing the automation in the R&D. And it's not that I don't think that's important. I think that is important. We sort of felt that by treating that as exogenous, we would make the insights a little bit more transparent, a little clearer. I also think as a byproduct, how you endogenize, the way R&D affects automation, how you build that production function might be very important in terms of what kind of results you get. So, but those, we're certainly going to work more on this, and I think it's a very rich, the thing I began with, it's a very rich area for exploration. So, Ben, I don't know if you want to add some things.
I'll just add one more comment into the questions about labor share and markets, market power, and sort of how do we think about that, and just say that I'm sure Chad is as well, and Philippe as well, very open to that. I don't know that we should read a declining labor capital share as telling us about automation. I mean, we've got possible market power. We've got China and WTO in 2001 in the U.S. is a coincidence of the decline in the capital share with that. So it could be a trade story if something funny is going on with wages in China, which you could tell stories about. So I think that sort of the jury's still out on that. So we don't want to sort of overstate that. And in fact, there's some interesting stuff in the paper about robots and capital shares by sector, using some data that Chad put together that also wouldn't leap out at you and say it's automation. So I think that we should be very open on that. And of course, it's hard to put one story forward with one trend. But I think that think of our contribution here as trying to just open the door to a bunch of different theoretical perspectives that could help us think about AI without making a strong claim about empirical evidence.
Thank you.